Okay, so again, chapter 9 was a pretty quick and easy one. So now we're going to be diving into chapter 10.1. So again, 10.1 is going to be dealing with receivables. Since we talked about cash and how readily and easily available cash is. But this is when we're coming to the conclusion where we allow our customers to owe us, right, on an account, right? With that being said, because if we do that, we are also at a potential risk, right? So what receivables are is pretty much allowing other people or it's another form of pretty much payment or cash, right? We allow our customers to owe us either on a credit card, on an account in general, or we just allow them to give them credit to make all the purchases that they want, all right? But because of that, that's exactly what accounts receivable is. Because of that, we have to also acknowledge that there is a possibility that, of course, these customers may not even pay us back. All right, and that's where we're introducing to you what's called the allowance for doubtful accounts. Many other companies can use just regular bad debt or uncollectible debt. But in this case, they're all generally the same exact concept. And how the allowance for doubtful accounts actually works is, of course, with the conclusion that, let's say, our customers, they refuse to pay or they file for bankruptcy or just anything happens, just like, in our economy right now, we are unfortunately half of the world, half of the country is unemployed, so they're unable to pay off the debt that they owe. So when this happens, then we have to consider having a contra account for the accounts receivable, which is going to be known as the allowance for doubtful accounts. So with that being said, when we have someone who isn't willing to pay or cannot make their payments, right, due to either they filed for bankruptcy or doesn't even have enough money to pay, then we need to make the executive decision whether to transfer a section of the accounts receivable and place it in a placeholder just in case. What if they do have one day the money to pay us back? All right. So with that being said, on an individual basis, with the allowance for doubtful accounts, we will know three things. We will definitely know who owes us, we will know how much they owe us, and we know exactly when they call us and tell us or send us a letter, or even if the debt collector calls us and say, I'm sorry, this so-and-so is unable to pay. Then we know those three factors, right? We know who, we know how much, and we know exactly when it happens. So that's where you're going to make the executive decision to transfer the amount of what that person owes us and place into the allowance for doubtful accounts, right? Okay, so what an allowance for doubtful accounts, again, is a contra account. It's going to reduce or decrease the amount of debt that someone owes us. But that doesn't mean they paid us off yet. It's just going to sit there until we make an executive decision to go ahead and proceed with that. All right. And when we proceed, that will be the next portion, which I'll talk right after this. So how we journalize an allowance for doubtful accounts. So let's go ahead and take this example here. Okay. So example, on December 16, Mr. Sanchez buys $100 of toys on account, okay? He pays $20 every month, starting in January, all right? So then on March 20th, he files for bankruptcy, okay? And he can no longer pay us, all right? So here, we're going to start from the very beginning. We're going to start on December 16th, right? So he places it on an account. He purchases from us a total of $100. Okay? We made sales to him. He bought toys. He placed it on an account. All right? January rolls around. We reduce his accounts receivable because he's making his $20 payment. So January, he made $20 payment. February, he makes another $20 payment. And then all of a sudden, in March, he goes ahead and files for bankruptcy, and a debt collector calls us and says, hey, Mr. Sanchez is no longer able to pay for your debt, for the debt that he owes you. So what you're going to do is you're going to make the executive decision, okay? He owed us $100 in the very beginning. He so far has paid us a total of $40. So that means he still has $60 left that he owes us. So what we're going to do is we're potentially going to move the his portion of the account receivable, and what we're going to do is we're going to place it into the allowance for doubtful accounts. Okay? So here is my debit to my allowance for doubtful accounts and my credit to accounts receivable. All right? All right?
Oh, yep.
Okay?
Yep.
Now, with that being said, because we're placing it into the allowance for doubtful accounts, that means we still have the possibility to collect his debt until it's been exhausted. So you have to realize that it's not, if they called you and said, I'm not going to pay, you don't just write it off right away. You need to take the extensive measures to properly collect the money. All right? So with that being said, meaning sending him phone calls and sending him letters, trying to exhaust all your capabilities. You might have to even follow him for 6 months. Maybe he found a new job and now he can pay, but he's not willing to pay you back. So again, you may be following a person for as long as you'd like to follow. But so most companies, they decide to just not even deal with that. So that's where they start creating what's called a bad debt expense, okay? So what a bad debt expense is, once you've exhausted and you've done everything you can in your power to try to collect that debt, and it's been 6 months, it's been 1 year, whatever it is, you finally come to a conclusion that you're never ever going to collect that debt, then that's where you can go ahead and proceed to the bad debt expense. All right? So what a bad debt expense is, it's actually an adjustment entry that is done at the end of a given period. Okay? It could be done at the end of the year. Typically, it's done at the end of the year. It could be done every month, just depending on what your company views your accounts receivable as. Now, general rule of thumb is when you are doing business, especially for large or major corporations, right? If you're going to allow people to have credit cards or whatever accounts to your store, the biggest assumption is you already know yourself that you're not going to be able to collect every single penny by you distributing out all your accounts out, right? You realistically know that. Now, with the whole rule with IRS, it doesn't look very good on your paper if you're just going to write them off as losses, right? Because then what is your company really doing? It's basically giving out free merchandise, and that doesn't look very good to your company. So the general rule of thumb is you generally, if you do have an accounts receivable, you would calculate maybe 5%, anywhere from 0 to 10% would be the maximum amount that a corporation can cut off as a bad debt write-off. As in, you're never going to collect it, so I'm just going to get rid of it off my books. They allow you to do that. Now, you should be very careful, though, because, again, you don't want to write too much off, and you definitely want to make sure you try to do your best to collect all that money. So with that being said, there are 3 key factors when we're dealing with bad debt expense, right? So what a bad debt expense is, it's going to be based off on an estimated amount, meaning you will not know who. All right, so this is just a random number that you're going to come to conclusion for. So if I have, okay, so for example, the people in this room, right? So Robin, right? Let's say Michelle also owes me money, and Mr. Sanchez owes me money, right? All three of you owe me money. Now, when I reach the end of the conclusion, right, I can't predict, Robin, that you will pay me tomorrow. I cannot predict that you will pay me next month. I cannot even guarantee you'll pay me next year. I can also apply that concept to Mr. Sanchez as well as Michelle. I don't know if they're going to ever pay me. So this is where you're going to come up with that estimated amount. And with IRS, they allow anywhere to from 5 to 10%. It's just a random amount. It's just an estimated amount because you won't know who, and this is definitely going to be uncollectible debt that you think they're not going to pay you back for. Obviously, in a real world, in a perfect world, the people that owe you money, they're going to pay you back. But it's reality. We have some people who don't pay you back. So that's where this estimated amount is going to come from. You will not know who. And you will not know how much either. Because again, if Robin, you owe me $100, Mr. Sanchez owes me $500, and then Michelle owes me $200. Out of the three, if I'm going to claim that one of you was going to not pay me back, do I know how much? What if Mr. Sanchez pays me half and then says, forget you, I'm not going to pay you the rest? Can I make that assumption? Can I predict that amount? No, I wouldn't be able to because I can never know when that Mr. Sanchez may fall. I can blame Mr. Sanchez, but then what if Michelle says, I lost my job, I can't pay you back, and it just hit me randomly? Something like that can always happen, and especially when you're doing business and you're allowing people to have this type of, relationship, right? If you allow them to owe you money, you have to assume that you need to know that they have a possibility to fault on their payments. So you never know who, you never know when, right? You won't know who, you won't know exactly how much, and again, you will never know when it will happen, right? So again, Robin, I don't know if you're going to pay me back tomorrow. I don't know if you're going to pay me back next year. I don't know when you will fault on my payment, if that were ever to happen. So here's one way of looking at it. When you're dealing with allowance for doubtful accounts, you will know exactly who because someone's going to keep track of it. One day, the payment's going to stop. You're going to know who didn't make the payment. Okay? And you're going to know how much exactly. In this case, I'm just making a rough estimate so I can write off my loss, saying that I'm never going to collect this money realistically, because realistically, I'm not going to collect all 100% of my money. So this is where we come to a conclusion to make an adjustment entry to write off the bad debt that will not be collectible. Okay? So again, I already given you a rough estimate. You do not need to use it. But if you are dealing in a major corporation, you're more likely to follow that kind of guideline. Okay? So with that being said, there are two different methods on how we can write our bad debt expense off or to write our uncollectible debt. The first one is going to be the direct write-off method. Okay, and that's going to be primarily used for tax purposes only, and it is used for primarily the IRS. So here's the example here where we're going to write bad debt expense, and we're going to write it directly off of the accounts receivable. Okay, but what I'm going to tell you is we are not going to learn the bad debt write-off. Why? Well, are you the tax accountant? No. So unfortunately, you don't have the rights or the privilege, I should say, to be able to do this. Only the tax accountant can do this, all right? So we're going to learn the allowance method. The allowance method is governed by GAAP because what GAAP does is they tell you need to have the matching principle. You need to recognize your, you need to recognize your revenues. you also need to recognize your losses. So with that being said, being governed by GAAP, they tell accountants you should take this step. You need to do the allowance method, which in this case, I'll show you how and show you exactly what you have to do. But for this case, we're not going to write it directly off of the accounts receivable. We're actually going to utilize the allowance for doubtful accounts. So with that being said, that makes it why it's called the allowance method. Now, under the allowance method, there are two ways of looking at how you are able to write off the bad debt expense. You can only use one method and not both. Okay, you can't use both of them at the same time. You can pick and choose. It's whatever you'd like. But I'm going to go ahead and show you the two methods. So the two ways of doing it is called the balance sheet way, the balance sheet method, and the other one is called the income statement method, all right? So I'm going to show you the first one, which is the balance sheet method, okay? So we've looked very, very, very briefly on what the balance sheet really entails, right? So the balance sheet is going to entail a list of all of your assets, a list of all of your liabilities, and a list of all your equity, okay? And that's it. Now, under assets, obviously, you're going to have the accounts receivable, and you're going to also display your allowance for doubtful accounts. So this is why this is very important if you're going to recognize and using the balance sheet method, okay? So let's go ahead and look at this example and explain further, okay? So for this example, okay, it's estimated that $25,000 of a $500,000 accounts receivable is uncollectible. There is currently a debit balance of $5,000 in the allowance for doubtful accounts method. All right, in the allowance for doubtful accounts, record this adjustment. So here, we need to recognize three things, okay? First off, we're going to recognize what is the estimated amount for. In this case, it's $25,000, okay? Second thing you're going to look for is the keyword accounts receivable, all right? Here you go, 500,000 of is accounts receivable. We recognize the word accounts receivable, right? And I've explained that it appears on the balance sheet, okay? And what else also appears on the balance sheet is going to be your allowance for doubtful accounts. So in this case, we currently have a debit balance in the allowance for doubtful accounts, meaning we have indicated that someone has a potential amount of money that they owe us. So what we're going to do is, with the estimated amount, that's going to be your total credit balance in the allowance for doubtful accounts. If there's currently a debit balance, right, the method here is going to be once you recognize the word debit, you're going to add the amounts together, okay? Because we need to get to a total of $25,000 in my allowance for doubtful accounts as a credit. So, by having to add these things in, if you're already on the left side, 5,000, how many more do you need to take to get to the right side to reach 25,000? You need to backtrack 5,000, and then you need to keep going an additional 25,000, making it a grand total of 30,000. So this is what the method to this madness is. I made a little box at the very corner to make it easier for you to recognize. You're going to recognize one, the estimated amount. You're going to recognize, did you see the keyword accounts receivable? You're going to use the balance sheet method. You recognize the word debit, you're going to add those quantities together. If you recognize the credit balance, you're going to subtract that amount. So in this case, that's what that method of madness is. So we've already calculated that we have a total of $30,000, okay? So how we journalize it is you're going to journalize bad debt expense because it's an expense, right? And how do we increase our expenses? We debit them. And then again, validating that our credit balance is going to be for the total of 25,000. If we have a current balance as of right now, a debit for 5,000, how much more you need to take to make it to equal 25,000? And that's exactly what you're going to do. You're going to recognize that you're going to have a debit there. You're going to add those two quantities together to make 30,000. And this is your journal here. You're going to debit your bad debt expense for 30,000. And you're going to credit the allowance for doubtful accounts for 30,000. Okay. Same scenario here, except this time I have a credit balance of $5,000 in the allowance for doubtful accounts. So what are you going to do here? Okay, so the first thing is we're going to recognize what is the estimated amount.
25,000.
Good. All right. We see that right here is out of the $500,000 of accounts receivable. So right there, we recognize that does appear on the balance sheet. So if we have currently a credit balance of $5,000,
Oh, okay. So then we're going to take 5,000 away from that.
good.
That'll be 20.
Good. All right. If we're already left 5,000, how much more do we need to get to 25,000? You just subtract and get 20,000. You need to do 20,000 more. So good. That's exactly how you figured this one out. Okay, so that's the balance sheet method. Okay. Now the second one is going to be the income statement method. Now, we briefly looked at the income statement. We know that on the income statement, right, all you're dealing with is going to be your total sales. You're going to subtract your cost of goods sold and subtract out your entire operating expenses. Nowhere on the income statement will appear accounts receivable or an allowance for doubtful accounts. So in this case, if we're going to use the income statement method, this is all you need to look up for. You just need to recognize the amount of the estimated amount. And if you see the word total credit sales, you stop there. And you just take the estimated amount. So in this case, example again, there is estimated that $25,000 of its $500,000 total credit sales is uncollectible. There's currently a debit balance of $5,000 in the allowance for doubtful accounts. So how do we journalize this adjustment? So understanding the rules I just said, what is the total amount that you're going to debit?
The 25,000.
It's
the only one that states the total credit sales.
Exactly. And that is exactly what you need to do, because we don't care about the allowance for doubtful accounts because it's not on the income statement. All right? It doesn't affect anything. All you need to know is you recognize the estimated amount. Boom. That's how much bad debt I'm going to write off. All right? So let's test you one more time. So, same scenario, except this time it is estimated at $25,000 of a $500,000 total credit sales is uncollectible, right? There's currently a credit balance of $5,000 in the allowance for doubtful accounts. Journalize this adjustment.
Okay, so it's still the same. 25,000.
You are correct, because now we recognize the key word here is total credit sales. We recognize that it's automatically going to be the income statement, so we don't care for the amount in the allowance for doubtful accounts. And that is it for chapter 10.1, right? Any questions? And that's all I really want you to get away. It's just how to deal with what happens when you are dealing with having receivables, allowing customers to owe you money. So again, here's a little review here. We recognize that if we have a receivable, right? This is what's going to happen when you create your receivable, right? Then this is what's going to happen when you get that phone call and say that they can no longer pay you, right? So here's your allowance for doubtful accounts. So this one is where the reason why we have a debit or a credit balance in our allowance for doubtful accounts is because we're doing this during the year. Okay? So again, the allowance is usually for doubtful accounts, usually happens during the year. Okay? And you know who, and you know when, and you know how much. Whereas the bad debt expense happens usually either at the end of a given period, okay, whether it's a year or whether it's every month. And you don't know who, you don't know how much, and you don't know when the debt is uncollectible. All right? And that's where you use the bad debt expense and the allowance for doubtful accounts. So again, we learned two different methods, which is the direct write-off. You need to know at least what it is, but you will not be doing it because you are not the tax accountant. We are going to be doing the allowance method, which breaks it down to two, right? Either you do the balance sheet method or you do the income statement method, okay? All right, so let's go ahead and get started with the exercise here for chapter 10.1, allowance method. Okay? So to build up, this is what we're going to be doing. So here you go. So on December 15, Robert buys a total of 100 coffee mugs for $9.99 each on account. Okay, sales tax is 8.375%. Okay, so this one I updated the tax. So how am I going to journalize this transaction?
Alright, so this is still, we'll put the date, December 15th. And this is gonna be, well, I could put Robert's name or accounts receivable.
It's going to be accounts receivable. In your description, it will be Robert's name.
Okay. So accounts receivable.
Okay, because he's putting on account. Good.
Okay. So it's still a sale,
Mm-hmm.
sales tax.
Good.
For the credit columns. So let's see here. So let's see here. The total sale is $999. Oops. Yeah, so sale is in the credit column $999. And then the tax is $82.42.
$82.42. 82.42.
So that makes the debit in the accounts receivable column for $1,081.42.
Good. All right. And then in parentheses here, you could go ahead and write, this is Robert. All right. And you can write whatever you want to write. So Robert, 100 mugs.
On account, whatever. Well, I don't need to say that, that's evident.
Mm-hmm. Okay.
100 bugs for $9.99 each.
Okay. At $9.99 each. Okay. Good. So then on January 15, Robert sends a check for $25.
Okay. So. Yeah. It's got to go toward $25. I mean, in my head, I know what I do in QuickBooks, but I'm having trouble putting it here. So I have to apply it to the debt.
Mm-hmm.
Um,
So he's paying off what he owes, right? He's paying a portion of
Right.
what he owes.
right, right.
So what are we collecting?
Well, we're collecting money. I don't know. I don't understand the question.
Yeah, that's right. We're collecting money.
Or money. Okay, making sure that was what you meant.
Yes, we're collecting
All right.
money. Right? And because he brought a check, it's going to go straight to our checking.
Okay. Oh, so checking will be the description.
Mm-hmm. Because
Okay.
that's he gave us a check. How
Okay.
is it cash?
No.
No.
So is it going to be the $25?
Good.
Right, and that will go to accounts receivable.
Good. It will decrease the amount that he owes.
By 25. Okay.
Okay. Good.
Okay.
And then you can make a little note here. Robert paid.
Paid 25 toward
Yep.
the balance.
Yep.
Right?
Mm-hmm. You can say paid a portion. Okay. To his debt. Okay.
Okay.
All right. So then, so question number 3 says, on February 15, Robert informs that he can no longer pay due to his financial circumstances. So what are you going to do here?
So let's see here. 15th. I'm going to use that allowance for doubtful accounts.
Good. Allowance for doubtful
And
accounts.
He still may pay, but we're preparing for in case he doesn't.
Good. Yes. We're basically transferring the amount that he owes and we're putting in a placeholder for in case he does attempt to pay us again. But it's at risk for potential writing off the loss.
Right.
So good. So here we have allowance for doubtful accounts. And what is
And
my... Go ahead.
Oh, and then there'll be accounts receivable.
Good. Good. Because, yes, we have to move it from the accounts receivable into the possibility of of bad debt.
Right.
Okay, so
And
good.
So now the balance due is the $1,056.42.
1,050. Yes. Whatever, $25 minus the
The original amount.
mm-hmm. And what was that again?
$1,056.42.
Good. So he owes us 1,056.42. All right?
Yes. Okay, and that is in both the credit and the debit column.
Good. All right. So then a couple months later, then on June 15, Robert says he can pay $25 this month and sends another check. So what do we have to do here? Right now, it's in another account. What do we have to do here?
So, let's see here. So will it be back accounts receivable?
Okay, on the debit side?
Yeah, for the additional $25 he's sending,
Mm,
or no?
all right, in this case, where is the money that he owes us?
It's in the allowance for doubtful accounts.
Mm-hmm. Now, can we ever make a payment directly out of the allowance for doubtful accounts?
No.
No, we can't. So how do we make it so that we can be able to take it out of the account receivable if we're reducing his amount that he owes us?
I don't know. I'm lost right now with that.
Okay. So this
So-
one, okay, go ahead.
Well, I'm just going back to the very beginning. It would be sales.
He didn't make a sales yet. He already made the sales.
Continued
Mm-hmm.
sale, yeah. So
Mm-hmm.
it's not accounts receivable,
Is it not?
or is it? It is accounts receivable. That will be right.
Right.
The description account is accounts receivable for the debit.
Yes. So what are we doing here? What are you gonna do here?
Yeah, well, wow.
So here,
Oh, I think Robert doesn't know he's not on mute.
Nope. I want to interject here,
Oh,
but
That's fine.
finish this transaction first.
okay. So instead of paying off directly the accounts receivable, what do we have to do? How do we place? How are we going to make it active again? How do we make this account active? What do we have to do?
I guess I don't know because I thought it was sales. So
Mm.
I'm
Okay.
struggling with this one. I don't know.
All right. So for here,
Where'd you put the money at?
Oh, checking.
not yet.
No.
Oh. Then
So in this case, you said earlier that the money that you placed earlier, right? You put it in the allowance for doubtful accounts.
right.
So that's just saying like we're placing it to another side, right? How do we put it back into the accounts receivable?
Well, now will it? See, I would think that it would be the opposite of the transaction we just did. So
It's exactly correct.
okay, but I thought I said that, and you said we can't for allowance. Okay.
Oh
Maybe
no,
that's
because
it.
you said you said
Okay.
you were gonna do the accounts receivable and you're going to do $25. That's the wrong part.
Oh, I gotcha. Okay.
You need to reverse for the
It is
full
accounts
amount.
receivable and then allowance for the full amount.
Yes, you have to do for the full amount. Why? Because that's what he owes us. We're not just going to take out $25 and say he
Oh,
paid towards it. We need to activate or reopen his account. And it's true. It's like on QuickBooks, right? If you're going to deactivate someone's account and reactivate it, it's going to show up for whatever the amount that he owes you for, right? It's not going to say $25. Of course not. It's going to be reactivated for the full amount that he owes us. So this is exactly what we're doing here. We need to reverse the transaction for the full amount. So the allowance for doubtful, so I'm gonna abbreviate because I don't have space here.
Right.
Accounts. All right, we're gonna reverse the transaction for the full amount. So the debit here is going to be for the 1056.42. Same thing here on this. Okay, so now his account is active for the full 1056.42. All right. Now, if he sent us another check to pay towards it, how do we journalize
we're gonna
this.
put, that's gonna be checking
Yes, it's going to
for the
be
25.
good.
And then that's accounts receivable.
Good.
Okay, for the 25 in the that column. And then okay.
Okay. This is where I want to interject. Now then, you are reactivating the accounts receivable, which is zero interest. Your business may say, I may go to your business and say, I can pay you $25 a month. Okay, I make a contract with you.
Right.
In that case, what account instead of accounts receivable, what account would you use? You know,
For somebody making payments.
I'm going to be paid. Yeah. So what account would you use?
Um,
You can either do this every month as I send you checks, or you could put me on a payment plan.
right. Okay.
You want to use notes instead of accounts receivable. You want to use notes receivable.
Oh. Oh. Okay. I get it.
Oh,
Okay. Now the difference between accounts and notes is interest. Notes, I gotta pay you interest for this
Okay.
plan.
Right.
Accounts, there is no interest.
Right. Okay.
So on the top of the page at accounts receivable debit, you will make that a notes receivable and take it out of my allowance stuff accounts, and there'll be checking, debit, notes receivable, credit, and you're going to have to, and then you're also going to have to put down interest income and put down whatever interest I owe you for this month. Does that make sense to you?
Yes, I get it. I have never
Okay.
done that with my companies, yeah, so
No.
I'm not used to doing that, but yeah, I've had where people just
Right.
accept the payments and they never charge them anything. But yes, I totally,
Yeah.
I get what you're
Again,
saying.
we depend on your company. Like I said,
Right,
if I don't want, I gotta go through the hassle of
Right.
going to accounts receivable and allowance. I just put you on notes receivable and just take your payment.
Okay.
But yeah, for that effort, I'm going to charge you interest,
Gotcha.
and that's a formal document. You need to send them a formal document for signatures that they agreed to this payment plan. But that's one thing I want to say. And one more thing, I do not appreciate that I can't pay you. That reason being because you charge too much.
I never said it was Robert Sanchez. It's just Robert, man. That's a very common
No.
name.
Before it
You're
was
just
Mr. Sanchez.
And, but that could be anybody. That could be Maria Sanchez. That could be Lionel Sanchez. That could be anybody.
We're watching
Sanchez.
here.
I'm not.
if you guys weren't so cute, I wouldn't buy from you anymore.
All right. So
Wrap it.
in this case, I'm not going to go too much in further detail because I have to assume that, with this kind of lecture and this kind of class that we're teaching the very, 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 very basics of
Basics.
this. Just understanding what you need to do when it comes to accounts receivable and allowance. So
So
that's
one
actually,
question before we move on.
go ahead.
Would I right here under this line then update the new balance with the allowance for the doubtful debt? Because or would I
Well,
just leave it right here as right now? That's
you can just leave it as is because we're not dealing with ledgers just
do
yet.
that. Oh, gotcha.
Again, and we'll see that when we move into Coffee Cafe, but this is just being able to just recognize and what you need to do to journalize because that's primarily what we're doing for the first quarter, right, of the class. I mean, first 2/3 of the class. We're
Right.
trying to just get the foundation of understanding to just journalize, because that's what the primary of this goal is. We piece it together at the end of the last couple weeks. We piece it together by doing the class project. So you're seeing all of the concepts that we learned, how to journalize it, how to do the ledger, and how the ledger and the financial statements start all piecing together. Okay, so in this case, I just want to just for you to just for the both of you to just understand what the transaction is at hand and being able to record it. So in this case, I'm not going to go too extreme because again, there's
Right.
no mentioning of any payment plan or anything like that. So
Gotcha.
as far as that, just keep it as is. We're just understanding that this case, we're doing what your company says, where we charge them. We don't expect anything, no late payment, no anything. So
Right.
we just wanted to make sure we collect our money back.
Gotcha.
All right. So in this case, here you go. We recognize that we have checking and we decreased our Robert's accounts receivable to now it's 1031, correct? 1031.42. Okay. Now again, we're not dealing with the ledger, so we on our end we can't see that. All right. But when we deal with ledgers and subsidiary ledgers, that's when you will be able to see that. Okay. So here we've reduced the accounts receivable, and you can go ahead and write a note here that Robert paid a portion of the money. So Robert paid a portion. Okay. All right. So then on July 15th, Robert files for bankruptcy, right? And the bank collector informs you that he can no longer pay you anymore and you can no longer collect it. All right? So this is pretty much a definitive statement saying he filed for bankruptcy. Now, chances of him to ever pay anybody, because we don't know how much debt he's collected with other people, you're more likely not going to able to collect this at all. Okay, because usually with bankruptcy, you're good for a whole year, I believe. And if you want to chase him down for a year, you may do so, but you don't have to. I wouldn't think you need to. It's only, well, the $1,000 does count, but I mean, if you want to chase him down for a whole year, it's up to you. But in this case, I'm going to go ahead and make the assumption that I'm not going to wait that long. So what's going to happen here? What do I have to do here?
Okay, so now
July 15.
my notes properly. It looks like now we can do a bad debt expense.
Okay, so again, we can do that, but we haven't reached the end of a given period. So in the case in question number 6, you will reach the end of the period. So we're doing it every year. So in this case, this is current year. So right now we need to establish or reestablish.
We'll still go back to the allow for doubtful
Correct.
account.
We're going to recognize the same allowance for doubtful allowance for doubtful accounts. Okay.
And that is going to be for the $1,031.42.
Mm-hmm.
And then it is the next description is accounts receivable. And then the credit again will be the $1,031.42.
Okay, so 1031.42. All right. So there we are. Good. And then if you want to make a note, you can make a note that this is Robert's account. Whatever you'd like.
Right. Robert bankruptcy
Sure.
bankrupt.
Okay, so no longer can pay. Good. Now here, on December 31st, your company estimates that a total of $2,590.54 of its $29,476 $75.72. Wow. Of accounts receivable are uncollectible, including Robert's debt. Right? You have a total of credit balance of $157.62 in the allowance for doubtful accounts. Okay? So along the lines, Robert wasn't the only person that faulted on their payment. You have a bunch of other people who also faulted on the payment. So therefore, it fluctuated the allowance for doubtful accounts. So in this case, the $157.62 does in fact include Robert's debt, which was a debit balance. But again, we were dealing with multiple people. So how are you going to journalize this?
Okay, so, well, this is sounding like this is at the end of the year.
Good,
So now I will be able to use the bad debt expense, right?
good. Bad debt, good, because we're making an adjustment now.
Right. Okay, so then. Okay, so now let's see here. I'm confused a little bit on the amounts. So, the company estimates 25. Wait, let me see what I did. So, 2590.54. If it's 29,000 minus 82, accounts receivable are uncollectible. So let me see here. So for that first portion, I have 26,885.18.
Say that again, 26,000?
Yeah, for that, just the first part. This does not include, oh, it is including Robert's debt. Okay,
Mm-hmm.
I'm reading. So the total then in between that, from that 29,475.72 is $26,885.18.
Okay, let's take a step back. All right, so this is, what method are we using to write off this bad debt expense?
Well, right now, would it be not the direct write-off, right?
Mm-mm. That's for tax purposes only.
Allowance.
Okay. Now, which one? There's two methods, right? There's the balance sheet method and the income statement. Which one are we actually looking at this time?
Is this the balance sheet?
The balance sheet, right? Because what keyword do you recognize there?
Accounts receivable.
Mm-hmm. Accounts receivable.
Yeah.
Good. So with that being said, right? So if you remember that little snippet thingy, the little methods of the madness, or that little what do you call it? That little shortcut or cheat sheet. So here to recognize this one, right? What is the estimated amount?
Wait.
What? Yeah, just go ahead. Just answer the question.
Well,
What is the
estimated amount I had for that difference of those two amounts was $26,885.18.
Okay, so for this one, we do not need to do any calculation here just yet, because this is just saying out of this amount, this is how much we're not going to be able to collect. There's no calculation there that you need to calculate.
So
Right.
it's the 29,475 and 72.
That's your grand total of amount of accounts receivable that you have outstanding. So the 2590.54 is what you're not going to be able to collect.
Oh, okay.
So that's the estimated amount.
Okay, gotcha.
All right?
So that's going to be in the debit column, that right there.
No, not yet.
No. Okay. Oh, okay.
Okay, not yet. Now that we have this estimated amount, right? So the next line is that you see that there is currently a credit balance in the allowance for doubtful accounts for a total of how much?
157 and 62 cents.
Good. Now, with the so you're going to take this amount right here, right? If
Right.
your goal is to get to 25.90.54 in the credit side, and you're already 157 in there, right? You're already in the credit side already. You need to subtract these two numbers to get the total amount that you need to add or subtract, I'm sorry, to get to the total of 25.90. So in this case, the goal here is that at the end of the day, you need to have a total of 25.90 in credit balance in the allowance for doubtful accounts. Right now, you have 157 credit balance. So how many more do you need to get to equal 25.90.54?
Well, minus the 157.62, I'd need $2,432.92.
Good. 2000, what was it? 2002, 4?
$2,432.92.
And that is your answer right there. Okay. So the shortcut here is there's three things that you need to look for. One is your estimated amount, which is the 25.90. Okay. Second thing is you got to look for the key word, which is accounts receivable, which indicates that this is the balance sheet method. So therefore, we do care on what the balance is in the allowance for doubtful accounts. If it's a debit balance, we need to add the two quantities up. If it's a credit, we subtract the two quantities. Okay, so what quantities I'm talking about is whatever the amount is in the allowance for doubtful accounts, and you're going to apply it to the estimated amount. So in this case, we had a credit balance of 157. We need to subtract that out of the 25.90 to get your grand total of $2,432.92 more to have a total credit balance of the 25.90. Yes?
Yeah.
Did that make all sense? That was a lot of numbers I just...
I know. We'll see.
All right, so here, allowance for doubtful ACCT. Okay, for the same exact amount for 2432.92. Okay. All right. So here, the following problems are not related to problems 1 through 6, so these are all separate. So number 7 says, if a company estimates that 20,000 of its 500,000 accounts receivable are uncollectible, there is currently a debit balance of $5,000 in the allowance for doubtful accounts. The adjustment entry will be
I'm rereading it because I need to
this way.
type the pages. So. Okay. So. Now, are we doing this in this journal here, right?
Mhm.
The one right under it. So it will be the allowance for doubtful debt, right?
That's one of the accounts.
Okay,
All right.
that's not the first one then. Okay.
Okay, so what's the key word here? If your company is estimating, do you know who?
It's an estimate.
It's an estimate. So do you know who's going to owe you this money?
No.
So what's my assumption here? If I don't know who, what am I going to be using?
it's the allowance for doubtful accounts.
That's one of the accounts.
Oh, okay. I already wrote that one, sorry.
So again, here I have the review slide up right now.
Okay.
So during the year, we do know exactly who when we're dealing with the allowance for doubtful accounts.
Right.
If we don't know who and it's an estimated amount, you're going to use bad debt expense.
Oh,
Okay, so in this case, what is my journal going to look like? So this again, the question is a company is estimating.
okay. So it's the same. It's going to be the bad debt expense.
Good,
Okay. And then the account underneath is the allowance.
good. There you go. So it is one of the accounts, but it's not the first one.
All right. Okay. And then the company estimates 20,000 of it. Currently is that, so the amount is going to be 25,000.
Yes, perfect. There's currently a debit of $5,000 in allowance of doubtful
Right.
accounts, so it is for 25,000. Good. Right. So question number 8 says, a company estimates that 20,000 of a 500,000 total credit sales is uncollectible. There is currently a credit balance of $5,000 in the allowance for doubtful accounts. What the adjustment entry will be?
Okay. Okay. So. I'm not sure why I'm not understanding which accounts these go to. I understand the amount.
Mhm.
Um,
Okay, so again,
Total?
if a company is estimating, what is that going to trigger you to do?
okay, well, that is well, it's estimating just what we did, so it will be the bad debt expense.
Oh, yes, good,
Okay.
good. Yep. So it's going to be bad debt, and it's going to be the allowance for doubtful accounts. Now here, which allowance method are we using? Are we using the balance sheet method or the income statement method?
Income statement,
Okay, and
total credit sales.
so what's the estimated amount?
So now it's just 20,000.
Good. It's just 20,000. Right?
Yep.
Okay. So again, if a if a company estimates that 20,000 of a 500,000 total credit sales is going to be uncollectible, there is currently a debit balance of $5,000 in the allowance for doubtful accounts. The adjustment entry will be
So this will still be the bad debt expense.
good because it's an estimated amount. Good.
And then it will be the allowance for doubtful debt.
Mm-hmm.
Okay. So, okay, so let's see here again. This gonna be, is it 25?
Okay, let's look at it carefully. What's the estimated amount?
Company estimates that $20,000 of its 500,000 total credit sales are uncollectible.
Okay, stop there.
Oh, okay. So it's 20,000.
Okay, so we established that it's the income statement, right?
Oh, yes. Sorry, there we go. Total credit sales. Okay.
Yes.
So it's 20,000.
It's just 20,000. Yes, we don't care for the allowance for doubtful accounts because it doesn't appear on the income statement. Good. Right? So again, let's try this again. If a company estimates that 20,000 of its 500,000 accounts receivable is uncollectible, and there is currently a credit balance of $5,000 in the allowance for doubtful accounts, the adjustment entry will be
So accounts receivable. So this is going to be the balance sheet,
good.
right?
Yes.
And that is. I'm still having trouble with which accounts. So accounts receivable and uncollected accounts. Credit balance. Okay. So it's going to be the allowance for doubtful accounts.
Where?
Well, I was thinking that would be the first one, but then that's clearly not right because you did not agree.
Now, what does it say here? A company
Okay.
estimates. Do you know who?
Oh, no.
No.
So it's still bad debt.
It's still bad debt. Good job.
Okay.
So bad debt, and then the allowance or doubtful accounts. So for this kind of thing, remember, because we're not doing the direct write-off method, we can't just write accounts receivable. We have to write it off the allowance. That's why it's called the allowance method.
Okay. All right.
Okay? So good.
All right. So, and then this one. Oh. There's currently a credit balance of 5,000.
Mhm.
So this is still just 20,000.
No. We do, because this is, okay, we did recognize it's a balance sheet. If there's a balance sheet, then we do have an accounts receivable. We do have an allowance for doubtful accounts. So whatever balance there is, it does matter.
Okay.
Now, if the goal in this kind of scenario, the goal is that you need to end up with $20,000 in the credit side, in the allowance for doubtful accounts, and you currently have a credit already for 5,000. How many more do you need to go to get there to get 20,000?
5,000.
If you have 5,000 and you need to get to 20,000.
Oh, you're adding to it. I'm confused on what you're asking. I'm sorry.
Okay. So your goal here is the estimated amount of number, right? What is that? 20,000?
Yes.
So that means when you're reading this, your understanding is that your goal at the end of the day is the allowance for doubtful accounts needs to be a credit balance of $20,000. That's it. That's your goal. Okay? Because we're dealing with the balance sheet method, we currently have a credit balance of 5,000. How many more do we need to get to 20,000? And this is why we subtract.
Okay, so 15.
15 is correct.
Yeah.
Okay. So in this case, right, we're already on the left side. I mean, we're already on the right side. We need to go how many more right to get to the end goal of 20,000, the estimated amount, right? So every time you recognize this, just think of the estimated amount, right, which is 20,000.
Mm-hmm.
If you're doing the balance sheet, that's your end goal. You need to have a total credit of 20,000, okay, or the
Okay.
estimated amount. If there's a debit balance, that means you need to add the estimated amount plus the extra debit that you currently have to get to 20,000, right? Because if you're left, right, how many more steps do you need to get to the right side? You need to backtrack and add those two numbers together. Okay? If you're already there, how many more do you need to get to the 20,000 is how I look at it. Right? So good. So expect to see something similar to this on the exam. And I will tell you this. 50% of my students get this wrong because they confuse and switch up the concepts. So be aware and read carefully, and hopefully you'll be able to do this correctly, right?
Yeah.
We will see this more often. You will see it in the study guide, so I'm not going to leave you high and dry. You're going to see this multiple times.
Okay.
All right. So that is it. I'll post the answers on the Google Classroom. And that is it for today because that's all I have, unless you want to just keep practicing and let me throw out some numbers for you.
Nope, I do that enough on my own, actually. And like I said, sometimes me working here at my own pace and rereading things as many times as I need to helps me do these worksheets that you have. I like I've already got most of them printed out for the next week.
Perfect. Good. So again,
yeah, I work on them on my own. I reprint them if I mess them up, just so I can have them for class and go over them with you. So
perfect. So again, utilize this little review worksheet because it pretty much tells you a lot of things, right? Dealing with the balance sheet, you just need to look at the estimated number. If you see the keyword accounts receivable, you need to recognize if there's a debit balance, you're going to add. If you recognize that there's a credit balance in the allowance or doubtful accounts, you're going to subtract. And then, of course, with the income statement, you just recognize the estimated amount and you just recognize the total credit sales.
okay.
And that's all you care about. You don't care about adding or anything. So it's just whatever it is. All right. Down here gives you an example of how to journalize that. All right. So, yes. So tomorrow we will go over chapter 10.2 and 10.3. So 10.2 is going to be dealing with interest. So we're going to learn about that.
Okay.
And then we're also going to learn about bank reconciliation. So since you've already downloaded everything, all right, and we'll talk about it tomorrow. So
Alrighty.
have a great rest of your day. If you
Alright,
don't have any other
too.
questions, okay?
No, ma'am. I am good, and I will talk to you tomorrow.
All right, perfect. Bye.
Alright.